You bought a shed in Windsor?
You made money in the housing market last year? No way.
Anything you shot on, you would have made on.
What would it cost?
That's the $1 million question. You're looking at North Bay now is at $1 million. I don't even think they hand you the keys anymore. What is it going to cost?
How much? Hi, my name's Nicholas Regina.
My name's Michael Sakuro.
And you're listening to
What Would It Cost?
Is that good?
Welcome back to What Would It Cost?
On this week's episode, we have our guest, Christian Catala from Green Bricks Capital.
Thanks for having me on the show.
No problem. Thank you for coming out.
Yeah, we were really pumped up to be able to host you and have it be that you're our first guest, as you were a big part of putting us on and teaching us the ropes of what it took to understand the private lending world and everything, you know, in between, right?
We're honored, buddy. I'm honored that I'm the first guest on your show.
Yeah, we attest a lot of the knowledge we learned about private lending, especially from yourself. So we look up to you as one of our mentors for that. So yeah, thank you for that, and we're excited to have you. So to get right to it, what's private lending consist of for a client that's looking to be the borrower?
Well, private lending basically is non-traditional lending. So you have institutions, so you have the A lenders, the B lenders, so you have the big banks, and then you have the B lenders who deal with, poor credit, higher ratios. But then you have the private side, which is what we specialize in. Now, private lending is more like those who don't qualify for the traditional A and B lending will come see us.
Right.
It is more expensive, but usually it's for a short-term period, 1-year term, to get them out of a certain situation, and then you put them back into institutional lending, right?
Right. And also, too, like a lot of people don't use it just for ones that can't qualify with the banks. They're looking for it even if they're flipping a property. Sometimes it's like, I want to get that property. I don't want to wait till a 30-day close or trying to get qualified. Let's just get in and out and flip that property.
That's
right?
a perfect example. We do a lot of construction financing. We do a lot of flips where there's no time. The time is money. They want to go in, get in the project, get it out as fast as they can. So private lending is a perfect resource for that.
Tool for that, yeah, perfect.
So on a typical term, bring us through it. What's the rate? Is there any fee associated with it in regards to lender broker? How long is the duration of that term? What are their options in between? And yeah, everything.
Ideally, what would it cost?
So, it's a good question. So private financing varies. There's different levels depending on LTV, type of property, if it's a residential or commercial, the area the property's in. So there's a lot of factors that contribute to the cost of a private mortgage. First off, there's a lot of these private mortgage companies, mixed they're called, and they're able to offer a lot cheaper rates than the traditional, very private lender, where it's just, we have investors who put out the money, their RSP money or personal money, we put out into mortgages. So the mix, same concept, but people invest in these mix, and the mix give them an average return rate of say 5 to 7%. You get that every month. The MIC takes care of the money, and they handle everything.
Right.
There's no, you have no say at that point. So you give them the money, and they invest it for you. They give you a check every month, and that's how it works, right?
So it's almost like an aggressive GIC where you're investing with them. The bank's doing whatever they want to do with that money, and you're making
exactly. Okay, so
understood.
MICs are good for that because some people have good credit, they barely qualify, and they need that 1 year to show their increased income. So a MIC's a perfect example. You can go there. It's not that expensive. You can probably looking at $499 to $599, even 6.5 for a first mortgage with the MIC, which is very, very cheap.
Right.
Lender fees will probably be between a point to 2 points. You're looking at lender fee and the broker fee, whatever the broker charges, right? So usually, typically on a first mortgage, a broker will charge 1%. But in industry, sometimes you have the greedy broker who wants to charge more than that. No comment, right? So no comment.
It makes the deal difficult.
Yeah,
line. Talk to us a little bit about the security in regards to if an investor were to hand over their capital to you and what you would do to that and what that process looks like.
So that's where we come in now. So we're not a MIC. So basically, we, through the brokerage, we bring in investors, and the investors basically are a per deal basis kind of investor. So we know they want to invest, say, $1 million, $200,000, and we have a bunch of them lined up. We have all their amounts that they have to invest. So what we do is we get a deal in, we vet it, we make sure the numbers work, and then we send it to them, and they give the final okay on it, obviously. Once they agree to do it, then we issue a commitment, we price it out, we send it out for approval. Now, the good thing about the way we do it is the investors have a sense of security, because unlike a MIC, these companies, they put their name on it. So say it's ABC MIC. when they register title, it says ABC MIC on it.
Right.
Yeah.
The way we do it is, because they're individual investors, the title will say the investor's name on it. So they'll have that piece of security knowing that their name is on title of that property.
Right.
Right.
So they like that aspect of it. So it's a little bit more expensive than mix. Typically, for instance, we start first mortgage at 6%. And depending on the LTV, they go as high as 9% if it goes up to 80, 85% LTV, right? So it varies. They're a little more lucrative than going through a MIC, obviously. And that's it. But basically, it's a partnership between us and the investor.
Right.
We don't make the decision ourselves. We basically will vet it. We'll say it's a good deal, and we'll send it to them, and they'll give the final, yeah, I like it. I'll put my money into
You're
it.
like the underwriter for the investor.
Pretty much.
Like explaining them
Pretty
the
much.
risk and what they're looking
Exactly.
towards. Gotcha.
Exactly. You know.
And what is it like? The $1 million question we always get for investors is what are they going to lose, or how can they lose out, or how can they lose that money, or what could happen if they don't pay, given if they're the ones secured on the property.
So there's a lot of factors, right?
Yeah.
The stability of the market, for instance, is very important, and it comes down to basically how aggressive you are as an investor and how aggressive you are as a broker. Even like I said, this industry is great, but there are the people who just don't care about, tomorrow. They care about today's quick buck kind of thing, right?
Yeah.
They're not out for the best interest of people sometimes, and they're out for their pocket, right? So my rule of thumb is I do not lend money on anything I wouldn't do. So I'll never recommend a deal to my investor if I would invest my own money into it.
Right.
So that's just the way I see it, and that's worked for me so far for the years I've been doing this. And I treat it as it's my own money. So I respect it, and I make sure that at the end of the day, they're gonna get their money back. So that's always our goal for our investors, right? Now, typically, we advise them of what to do and what not to do, but at the end of the day, it's their choice. And if they say no, it's no, right? And if they say yes, you advise them of the risks associated with that, right? But some guys want the higher returns, and they're willing to take the risk for it.
Yeah, and I could vouch firsthand to say that there's been deals that me and you have been doing, and you said, Nikki, I don't like this one. I don't think it's good for the investor. Let's put this aside and move on to the next one. Even though that our commissions were built into it was looking good from our end, but you were always trying to look out for the investor's best interest. And I mean, that's what creates that longevity and builds those really strong relationships. So you have, and you continue to grow that capital that you have to work with, right?
Exactly.
And typically they're always really happy with the Green Bricks deal because they maximize the potential of the yield that you're offering up to them on the rate. And, you lock them in for just those 1-year terms. And there's been those deals that they have those, 3-month interest penalties where the borrower comes out of the term a little earlier and they get their 3-month bonus payment on all the rate. And you let the investor take the upside of that. And they've been ecstatic when that's the case because it's kind of a surprise and something that they don't know about with our last deal being a prime example, right?
Yeah.
So
it's always, that's always something we try to build into all our deals.
Yeah.
An interest penalty. And the date, these people are expecting a certain amount of money over the course of the year. So they bring that money out into it. So when you come out and you pay it out early, it's not a benefit to the investor either because, sometimes it's their RSP money. So it's an investment for them. So they're expecting a certain return on their money, right?
Exactly.
So these interest penalties allow us after to, have time to put it back out there so their actual return isn't affected.
Right.
So we have up to 90 days or say.
Especially with these savvy ones, they look at his money sitting in the bank as money lost.
Exactly.
Yeah.
Exactly.
Yeah.
So that gives us a buffer at the end of the day to put that money out where they don't lose any interest for that year, right? So, and sometimes the great thing is you might overlap a couple of years where you have those extra bonus, but that'll make up for the years that the times when you have a shortfall on that early payout, right? So
yeah.
What's a typical term look like?
Usually they're a year. That's pretty standard. Like we issue paper for a year. Most 80% of mortgages are for 1 year.
Right.
You get the odd one that's for 6 months. You get the occasional bridge financing. You get 18 months, but typically I'd say 80 to 85% of their mortgages are
you never really went
are
past
1 year
that.
term. Yeah.
Right.
Yeah.
So someone wants to break the 1 year. What's that look like?
So he spoke. So someone wants to break the 1 year. It depends on the agreement we come at the beginning of the term. So at the beginning of the term, when we issue paper, dependent on the deal, how aggressive we have to be to win the deal, we may say, listen, we want this deal. We're willing to give you 1 month interest penalty or waive interest penalty entirely because it's such a good deal, meaning they're willing to pay 8% for a house that's impeccable, great location. and we know our security is safe there. So like sometimes you want to, be a little bit aggressive and take off those penalties, So like, listen, I'll take the chances because you know what? Even if it gets paid out in less than a year, my money's safe here.
Right.
Yeah. Yeah.
So why not?
And on an overall, from the borrower's perspective, right? Like there's a stigma on private lending, and I kind of want to, shine the light on that and say that there's a lot of high net worth clients that use this product for, their development and for their building, and it helps them move and shake and pound that pavement real quick and hop on to the next project without having to jump over all those hurdles that the big banks put in front of you steady, right? So it really allows for these guys to spread their wings and expand and scale their business at a rate where I don't think the institutions would be able to do right by them with that. So it's a very popular product with developers and builders. And then even with someone that we're, bringing to close on their primary residence, let's say, it's something where we're building out a game plan for them in the meantime on how to build up their credit, or they're getting a second job, or whoever else is on title with them is getting a second job to help out with the income aspect of it. And we think that it's going to take 6 to 12 months to really get them to qualify with a big bank. Well, if they find a house that they really like for the right price, and they have to jump into the market, to use private lending as a solution could be a big advantage as well, right? And although they're just interest-only payments, that client would have really lost out if they didn't jump into that house, and then, we would come in and refinance them 6-12 months down the road, but they would have lost out and not seen the upside that they would have seen by using the products. So tell us a little bit about that.
That's a great point, actually.
Right?
For instance, let's go back 1 year. Now say that you didn't qualify at the bank and you had this amazing house you wanted. It was $1 million, or 1.2 million, say. You didn't qualify at the bank. And you go, no, I can't. I'm just going to wait till next year to buy it till I qualify because I got a raise now.
Right.
Now, fast forward a year now.
Now
that house, 1.2,
yeah,
1.7,
exactly.
$1.8 million,
right.
600 grand more, where you could have gone and bought the house the year prior.
Yeah.
And fine, pay 6%, 7%.
Yeah.
What's that? What's in there? What's that going to cost you? $1 million? 4%, 3% extra over what the bank would charge.
Right.
Yeah. What's that going to cost you?
60, 70
Yeah,
grand.
even 100 grand, say.
Yeah,
sure.
Even if it was 100 grand, say.
Still on the upside of
Look,
what the
you're on the
value
upside.
You lost out
You lost out huge because,
Yeah.
And when you're talking about builders, 100%. So if you're going to build like an infill, 8 customs in a row, they come to us because we provide quick money. End of the day, you write it off against your profits. So it's a wash.
Right.
So
Right.
it's part of the expenses. You write it off, and you know what I mean? Like, it's a cost of doing business. But it's quicker than the bank. You save at least 2-3 months because banks take forever to approve those kind of deals, first of all, right?
Exactly.
So, and you're off to the races, right?
Yeah.
And a difference 3 months is huge. I had a client who we couldn't close in time, and because we had to delay in the fall, it had pushed back to the spring because the ground freezes, it has to thaw out. So like he lost 5 months, right? Because he wanted to go institutional.
Right.
You know, if he would have gone private, say the time, he would at least dug out the foundations before the winter was out. He could have started working on it.
Right.
So he's 5-6 months behind now because of that.
Right.
Right.
And that's a lot in
It's
their
huge
world.
because we only have a
That's
certain
big.
amount of time in Canada to build, right? We have like 8 months where it's easy to
Exactly.
build, right? And
Yeah,
after that, it's like
Yeah.
tough. If your foundation ain't dug out,
Yeah.
you can't do anything. You can't pour your foundation. You can't, you can't.
Can't start the project.
Can't start projects.
Right. Yeah, so the interest only can't be always looked at as money lost. It can be also looked at as money gained for sure, especially in situations like that.
100%.
Yeah. So has there ever been a real challenge and a client that you've had to say no to because of credit or down payment, or you just
Location of the
didn't
property.
feel?
Yeah. So
Yeah.
for me, one thing is ethics is huge for me. Like even people like sometimes come to me with people that are retired and like an 80-year-old nonna, like has a house and she wants to pull out equity in it, and I'm like, take her to get a reverse mortgage. She shouldn't be getting a private mortgage.
Right.
And brokers sometimes are insistent because again, there are those few
Right.
who care about lining their pockets before taking care of anybody else, right?
Right.
So yeah, I just tell the broker I'm going to the deal. Like,
Right.
I'm sorry, but the deal is it's a slam dunk deal if it wasn't this borrower, because the house is perfect. The LTV is like under 50%, super low.
Yeah.
But all we're doing here is creating a bigger problem for a year from now.
Right.
So,
Right.
and that's the thing. Like one thing we look at is exit strategy.
Yeah.
So if I'm gonna put our investors' money out, we gotta make sure there's an exit strategy. If there's not an exit strategy, I'm not interested in the deal. That's basically what it comes down to. No exit, no interest, right?
Right. Yeah.
Because at the end of the day, I don't want to inherit someone else's problem. I don't want to have to foreclose on someone's property. We don't want to do that. We're here to lend money out and help people get out of the situations they're in,
Right.
but not put a Band-Aid on it and just have to deal with it, you know, a year later.
Yeah. And that etiquette, respect, and honesty that you have, I'm sure is a big reason as to why you've had so much success in the short period of time that you've been out on your own, right? Because it's something that is not too common in the business from what I'm finding and what I'm seeing, right? So talk to us a little bit about how you scaled so quickly and, you know, just what that takes on a day-to-day business in regards to the schedule and the hustle and the staffing and everything else in between.
Yeah, well, I started doing privates strictly maybe 3 years ago. So I was doing regular mortgages. And I don't know, for me, it's like that whole concept of, you know, you have all these people chasing the same piece of the pie.
Right.
And I saw the private market as some, you know, a smaller piece of the pie with but fewer people, you know, in that circle.
Right.
So I decided, you know what, I'm going to take the plunge. I'm going to get on the phone, start, you know, looking for investors, you know, to bring to the brokerage, and we can start lending out money, you know.
Right.
My first investor was 200 grand, you know, gave us 200 grand to invest into the brokerage, and you know what, that's how I started. So it was tough at first. The first year, I'd say it was like pounding pavement, you know, basically knocking on doors, calling people.
Yeah.
And then the best thing for us has been like word of mouth kind of thing. So
Yeah.
one investor brought another investor on, then they told their family, and like, you know, it's a whirlwind, you know, and here we're today.
Yeah.
And I'm from a one-man show. I've got, I think, 8 agents now on our team.
Nice.
Yeah.
That's
we
awesome.
just bought a new office we're moving
Sweet.
into. So
amazing.
like, yeah, like, you know, so like
Yeah.
we're doing well. And it's like I said, it's
Yeah.
not about, it's organic growth, best way of saying it.
Yeah.
But it's also based on, you know, like we have morals. Like we have like a code that, you know, we're not here just for the quick buck. We're here to make sure our investors are happy.
Yeah.
Obviously everything's by the book through FISRA. Obviously things have to be very important. You know, like we vet all our clients. We have to fill out the proper forms, questionnaires, make sure they're able to lend money out, because you have to qualify obviously to be an investor.
Right.
But we do all that, but not just that. We're not here to take advantage of people. And there are brokers that don't like us because simply like we'll do a first mortgage, they'll want to charge 3%. I'll say absolutely not.
Yeah.
And I'll decline the deal because they're taking advantage of the client.
Right.
And they don't like me. I'll tell you, and they're probably the ones that, you know, say, yeah, don't use those guys but I don't take part in that.
Right.
You know, I don't want to be associated with that. Like it's just not us. It's just, I want to be able to sleep at night. I helped you, you know, you help you at the next level. You're great. I helped you, you know, have a nice day, you know, all the best to you.
Yeah.
You know, I don't want
to go to that point too, like with the brokers charging more, you having that etiquette and those principles that are your core values that you stick by. Again, that's what creates that longevity. And people talk, people find out, people could do research on Google and really get this information if they wanted to. So you think you're pulling the wool over someone's eyes and that you're fooling them and you know, you're going to see a bigger upside because, you know, they're dumb or they didn't look into it or you know a lot more than them. But everything comes full circle, right? So I think the brokers that are doing that, they're not the top performers. They're not the people that are able to maintain, sustain relationships with, you know, individuals and have those individuals screaming their names in other rooms when it comes to, hey, this guy's great with managing my money and I think that you should invest with him as well because the security is great on the asset and the return is amazing, right? And that's that confidence that I know your investors have in you and I have in you and Michael has in you for our investors that we bring to you, right? Is we know that that's what they're going to get with it, right? So admire you and I tip my hat to you, you know, for that.
Thanks,
in a big way.
Look at the longevity, not just a quick buck.
Exactly.
Yeah, sure.
It was an honor having you on the show. You're our first guest, and you put us on, and you taught us a lot about what we know, and we'll be forever thankful for that. So thank you for, you know, showing up today for our podcast, and it was an honor having you.
Honor was mine, boys. I'm proud of you guys. You guys are doing well, man.
Thank you.
Amazing.
Thank you.
Amazing.
Awesome.
And thank you to all of you for tuning in again to our second episode here. Be sure to check us out on all your favorite streaming platforms, as well as if you want to watch the video, check us out on YouTube and be sure to subscribe. We'll see you next week.
What would it cost? Next on What Would It Cost?
Prices have skyrocketed on both material and labor, especially labor. making renovations virtually unaffordable.
There's a lot of money to be made.
They rely on their equity to pull these loans out to do construction.
Taking that and being able to flip it, take the capital, and then allocate towards the renovation.
We're starting our builds at about $400 a square foot.
There's a lot of these arguments that could be avoided if there was just that communication and that transparency from the start.
If I'm not delegating professional licensed trades to each element of your build, what are you paying for?
Just wanted to announce the winner for the 2 tickets for the Sebastian Maniscalco concert next week, and the winner is Alicia D. So Alicia, if you'd please DM the Spark Financial Group page, it'd be greatly appreciated so that we can coordinate and get those tickets over to you. And for everyone else, we wanted to thank you and tip our hats to you for your efforts in regards to engaging with all our platforms, liking, subscribing, and really helping us launch the What Would It Cost podcast. We're fired up to continue to deliver content to our viewers and our listeners, and really, really excited to host all our special guests who are experts in the market, and that will give you an awesome insight on everything pertaining to the real estate market all across the board. I will see you soon. Ciao.